Welcome to Trendlines Over Headlines, the show where we break down the markets with some of the best traders and analysts in the world. We've got a good one for you today. Parets is joining us. A lot of you might know JC as the founder of All-Star Charts, but he's been a friend and mentor of mine for years. I don't think there's anyone that's had a bigger impact on the way I view the market, so I'm really looking forward to this one. But before we talk to JC, it's Friday, the markets are closed, so let's go take a quick look at how this week fared. Hey guys, thank you for watching, and just a quick reminder, if you enjoy the show, be sure to like this video and subscribe to our channel so we can continue bringing you awesome content. Thanks. All right, so all four major indices closed higher this week. The Russell 2000 continues to be the leader off the lows. It rose about 5%. Taking a look at the S&P 500, we closed higher for the fourth consecutive week, gaining about 3.33%. Now, this week was really constructive considering we closed above those June highs around 4,200 and the 50% retracement of the decline. Now, we're about 1% away from testing that downward sloping 200-day moving average, so that's definitely going to be an important one to watch over the next week or two. The Russell 2000 actually broke above its 200-day moving average today, believe it or not, and that level also coincides with the VWAP from the peak. So if we can continue to hold above that next week, that would be very constructive for the bulls. Looking at this week's sector performance, all 11 sectors closed higher by 1% or more. Energy led by a decent margin, rising about 7%. Staples lagged, but still rose about 1%. Now, my guest JC Parets is really liking this price action off the lows so far, so let's see what he has to say. All right, JC, good to see you, and thank you for coming on the show.
Yeah, thanks for having me. This is great.
Yeah, so there is a ton of noise out there, as you know, and you taught me a long time ago when it's this noisy, it's best to zoom out, keep it simple, and focus on price. So let's do that. It sounds like you've been liking the price action that you've been seeing lately. The S&P 500 is up about 14% from its June lows. You got the Wall Street Journal out here calling it a new bull market, and I'm wondering, what do you think when you see headlines like that?
Yeah, listen, I'm liking what I'm seeing because we've been long. So, if we're short, then I would not have liked what we're seeing, right? So, I try to keep an open mind. I've been through enough of these cycles to know that, the market's going to do what it wants no matter what we think is going to happen. Another thing I've learned about these cycles are the characteristics of different points in these cycles. Like when you live through enough of these, at this point, I've been at it for almost 20 years. So I've seen a few things, and a lot of the stuff that we're seeing is a lot of second inning type behavior. When you see these breath thrusts, we just saw the most amount of 63-day highs between the New York Stock Exchange and the NASDAQ since the spring of 2021. So yeah, 63 days, about 3 months. 3-month highs.
Yeah, about a quarter. We'll get into those bread thrusts. So save that thought. But I want to start off. Right. I want to start off with this chart you have here. You came out with a note a couple days ago, right before that big CPI print, where you shared this chart and you said you can't be short. Right. You drew some very clear lines in the sand and said if we're above these levels, which we are now, you can't be short. Right. So walk us through why these levels, and also why Ethereum here, right? I mean, because you have Ethereum right next to the granddaddy of them all, the S&P 500. So why is Ethereum such an important part of the puzzle right now, in your opinion?
Yeah, no doubt. And listen, we're recording this after market close Thursday, August the 11th. And, I would argue that we are in the process of potentially overcoming these levels, right? It's hard to clearly say, oh, they're past us. Like they might be, but, something else I've learned over the years is that, demand absorbing supply tends to be a process. And that is precisely what we're seeing in both of these assets. So we'll start with the S&P 500. You call it the granddaddy of them all. Yeah, kind of a big deal. These are essentially the support levels, the neckline, to put it in maybe more technical nomenclature here at the chart report, right? Know your audience. This is the neckline of a rounding top, a frowny face, a head and shoulders top. Call it what you want. It doesn't really matter the name. It's just distributive in nature. There is distribution taking place, and when that broke, that is the completion of a distributive pattern. And then sure enough, prices went substantially lower. Maybe did they meet their downside objectives, depending on who's calculating it and how you calculate it. But we did see a severe correction after that. Now we're back to the scene of the crime, right? We're back to that neckline that broke, that essentially completed that top, regardless of what you want to call it, right? We're back to that level. Are we just going to rip right through it? Maybe. I'll tell you
so
what.
Far we are.
I'll tell you, we might in the early stages of a lot of bull markets. That is precisely what happened, right? Quickly got back above former broken support, and it ripped from there. Go like cycle by cycle. You'll see that quite often. I'm a show me guy. Show me. I got to see it. I got to see it. But what's cool about the market is that it provides sort of guidelines, or as technicians, we can understand what the market would need to do to sort of prove that it is no longer in a downtrend. And I would argue, by definition, if it's making higher highs, it's not in a downtrend, right? Call me crazy. Right. And then Ethereum, and so the S&P 500, great representation of the stock market, right? No question. Ethereum, great representation of everything not Bitcoin. And what's interesting is just how much Ethereum has outperformed Bitcoin off the lows. Ethereum has doubled off the lows. Bitcoin only up 20-something%, right?
Yeah, save that thought, because I want to get into crypto at the end. But your point really is that as of today, we're above those lines in the sand, and for a lot of the major indices, that line in the sand is the June highs. And it's not just the S&P 500. You have the Russell 2000, the Dow Jones. So that first objective, right, the June highs has been achieved, right? And you already know, JC, that in the next week or two, if we hold these levels or if we continue to the upside, that the conversation is going to move to that 200-day moving average, right? In all the major indices, we're still below that downward sloping 200-day moving average, which, as you know, that's pretty much the poster child for technical indicators, right? But, I know you very well, and I know that you aren't so much of a moving average guy. Why is that?
Moving averages are like training wheels. Like once you know how to ride the bike, like, do you need those extra 2 wheels in the back? You probably don't. They probably slow you down, if anything. Moving averages are kind of like that. When you look at it enough, like at the beginning, like when you first want to look at charts, having a smoothing mechanism to help you identify the trend, because looking at price just isn't enough for you to do that. Moving averages are great. But once you're looking at thousands of charts a day, like we have for decades, as a team, also, you know what these moving averages look like, right? They don't necessarily need to be there. Also, there's no real memory at these moving averages. There's no memory at all. These are moving averages. These are smoothing mechanisms of actual reality. So, I will say that in the early stages of a lot of these bull markets, you saw prices doing exactly what they're doing and running up against these downward sloping moving averages and ripping through them and continuing and going on to the third and fourth inning of their bull markets, right? So let's put that into context. Now, the VWAP, on the other hand, there's real market memory there, right? There is real market memory, and those VWAPs, if I'm going to look at any moving average, it's going to tend to be the VWAP, with a few exceptions. Like we've got some like moving average models, and I really like those moving average models, by the way, too, like percentage of stocks above their 200-day, things like that. I really do like to quantify the work around the moving averages, less so than having them on my screen. I think to quantify it, I think 200 days is probably a pretty good number. Is it perfect? No. There's 252 days in the trading year, not 200. But I will say that the 200-day moving average does provide us with the simple fact that if prices are below their 200-day moving average, they're probably not in an uptrend. And if prices are above the 200-day moving average, they're probably not in a downtrend. Like that's good. That's good enough for what we use it for, which is just breadth analysis and the percentage of the stocks that are above that. So that's really where I find the true value. But the VWAP, there's real memory. So I'm really curious to see, how these things are acting based on their VWAP. You're looking at the NASDAQ above their anchored VWAP off the 2020 lows. So you're seeing prices respond positively to those VWAP tests.
Yeah, I like what you're saying there. And that's something you taught me a long time ago is kind of use moving averages more for trend identification rather than support and resistance, which I think for some reason there's an urge to do that, right? Like, oh, it's approaching that 200-day, you know, is that going to be resistance? And sometimes it does. And maybe that's where we get into trouble,
Yeah,
right?
the old trick is if you put enough moving averages on your screen, one of them is going to be support.
Right.
Eventually.
So regardless of your opinion on moving averages, a lot of these indices, you know, we've as powerful as the bounce has been, we've really only just retraced about 50%, about half of the decline. So what makes you so sure that the lows are in? I know we've seen a lot of breadth thrust, so if you could just kind of talk.
But to be clear, I'm never sure about anything.
Right.
So for you trading guys listening out there,
let me
I'm
rephrase
not
that.
insinuating that I know that anything is going to happen.
Right. Let me rephrase that. So what makes you so confident that we may have seen the low?
Well, I don't know how, I truly don't know how confident I am. I'm very skeptical about everything always, but I will say this: bottoms are a process. Okay. And the things that we saw earlier this summer, June in particular, were the types of things that you see at bottoms. Did we know that it was a bottom then? No. We had already seen leadership. Chinese internet bottomed in March. A lot of these growth areas bottomed in April and May, and we're already making higher lows in June. Those are the types of things that you'll see at bottoms, divergences. Meanwhile, in the middle of the summer, you had sentiment at the most bearish levels in history. Again, also something you see at bottoms. You had breadth washouts. The percentage of stocks above their 200-day speak of the devil was down to like 11%, depending on what index you were looking at. The average stock on the NASDAQ was down 46%. You had over 70% of the NASDAQ down 20%. So you had real, truly washout levels. When it comes to the 4-year cycle, when you do we have a seasonality composite that we look at that measures the every year since 1950, all of the midterm election years, which we're in, obviously, and every second year of every decade, which is we are in the year number 2 of the decennial cycle, and we create a composite. And you know when in that 4-year cycle it says to buy stocks? In July of the midterm years, which was last month. So when you combine all of these things to put us in an environment where stocks are ripe to appreciate in price, then we say, okay, what is the catalyst to do that? That catalyst has been the US dollar, has been weakening. And I know we're going to get to that in a minute, but it's really been the combination of breadth expansion, which again is the next thing you need to see. So you need to see breadth improvement. You need to see fewer lows. You need to see rotation. The losers stop going down. Like you have to stop going down in order to start going up. And those things were happening. That's step 1. Step 2, you need to see breadth thrusts. You need to see expansions and new highs. You need to see S&P 500 just got overbought for the first time since January of 2021, for example. These are the types of things you see in uptrends. They're not the types of things you see in downtrends. These are the things you see in bull markets, not the types of things you see in bear markets. But what we had seen for 16 to 18 months or so, depending on how you quantify it, is things that you see in bear markets, not things you see in bull markets. So now we're seeing things that you see in bull markets that we hadn't been seeing for a while. So the question is now, what does the 3rd and 4th inning look like? Well, further expansion and new highs. When you go sector by sector, you want to see more sectors seeing breadth expansion, right? You want to see all of the things that we've been seeing. You want to see more of it. And then we'll get to the dollar in a minute, but that's the catalyst. All of these things set the stage, but identifying the catalyst to move that, I think, is equally as important, and you're seeing it all. But the breadth thrust in the 2nd and 3rd innings of bull markets, go back and look. I mean, if we have the data, like go look, you'll see. You know, you don't see breadth thrusts at the end of moves. They're not evidence of exhaustion. They're evidence of breakaways.
Yeah, I mean, that was really what I was trying to get at, is the breadth thrusts, and you know, that last week, or I think maybe 2 weeks ago, we saw that spike in 20-day highs. And if you go back and look at the data on that, very bullish. You had a couple false readings, but on average, very bullish.
So this is good. Go back to what you were showing before. Go back to what you were showing before. You were showing the 20-day highs, right? So you're going to see the 20-day highs expanding before you see the 63-day highs. You're going to see the 63-day highs expanding before the new 52-week highs, right? So you see first the 20-day highs, now you're seeing the 63-day highs, right? So it's a process.
Right. And so far the process is playing out on cue for what a bull might want to see. Is that correct?
So as long as that continues to be the case, why on earth would I fight that? Because the moving average is there. You know, like, sure, could we see choppy action in August? Yeah, I think we probably do. You know, I think we see sector rotation. Some of the laggards like energy and materials start catching up. You're already seeing some of that. You know, some of the leadership group like tech and growth maybe cool off a little, right?
Well, listen, bonds are flat. You're getting ahead of us. So let's move on to the dollar, okay? You know, the dollar has been such a key piece of your thesis this year. You know, this entire year you've been mentioning that it's all about the dollar, and we've seen that play out, right? The dollar has been trending higher, hitting 20-year highs, and we've seen that pressure on stocks, crypto, and just about every other risk asset out there. I mean, those are really the two main ones. But we saw some weakness this week, right? We saw a little bit of a reversal in the dollar in the past week or so. Broke its 50-day moving average. It was above its 50-day moving average for the past 6 months, which was the longest streak, I think, since 2015. So a little bit of short-term weakness, but we're still above that 103 level, those 2016, 2020 highs. 103 seems to be the line in the sand. And at this point, it's just like a retest, right? So how excited can we get about dollar weakness if we're still above 103?
Yeah, and I think that's the bigger issue. It's not the dollar back to former resistance. That to me is the bigger hurdle, not the invisible line with whatever color you want to pick, right? You see what I'm saying? So what happened there at the end of 2016, beginning of 2017? What happened? Dollar peaked and started getting crushed, right? How did stocks and crypto do in 2017? Do you remember? It was like the best year ever.
I don't even think we got a 5% pullback that year. That was like the easiest year to be just long. I think short VIX was the trade that year. You remember
By the end of the year, remember that was when your drunk uncle in Thanksgiving was asking you how to buy Bitcoin. My high school buddies texting me about which cryptos to buy. That was the end of 2017. All of that happened with a weaker dollar. What happened immediately thereafter is the dollar stopped going down and started to rip. How did stocks and crypto do from there? They got crushed, right? All over the world, stocks and crypto, they got crushed. And when the dollar peaked, stopped going up in March of 2020, what happened? Stocks had the greatest 52-week period in history. And, you know, right, cryptos, NFT, DeFi summer, all that stuff, right? And then a funny thing happened last spring. The dollar stopped going down. And what happened to all that stuff, right? Came tumbling down, you know, severe bear market. And then look at the dollar. It's absolutely been ripping that entire time. So, and here's the thing. Why is that happening? Because the dollar has really proven to be the only safe haven. Because stocks got hit, worst start to the stock market in over 50 years. What happened in that environment? Bonds got off to their worst start since 1842. So yeah, bonds, treasury bonds were certainly not a safe haven. Japanese yen, which traditionally has been a great safe haven, also was not a safe haven. You know what was? It was the US dollar. So the way I see it is that if money's continuing to go into the US dollar, it's for a reason. It's trying to be safe, not being in the other stuff. But if money's coming out of the United States dollar, it's going into those risk assets, stocks and crypto in particular, and you're seeing that play out over the last month.
Yeah, so why don't you break us through this next one? Because, you know, I back to my last question, it was how excited can we be about the dollar if it's above 103, you know, those 2016, 2020 highs that you talked about. And this one, US dollar versus emerging market currencies, it's already put in a fail breakdown, right? And out of fail, a fail breakout. Out of fail breakouts come fast moves in the opposite direction. So if this is any roadmap for the dollar and the dollar does fail breakout here and falls back below 103, I can't think of a more bullish catalyst for stocks and risk assets than the dollar getting below 103. Would you agree?
I couldn't have said it any better myself, right? I mean,
is this a leading thing?
Like what is a leading indicator? Then 100%. Yep.
Is this a leading indicator? Why is it a leading indicator?
Because emerging. So let's think about what's inside of the US dollar index. It's a lot of euro, right? Very important.
Yen too, right?
A lot of yen, right? Obviously very important. Two currencies that got destroyed this year. Um, emerging market currencies are further out on the risk curve, right? So they're going to get beat up even harder in a strong dollar. So they're going to bounce back faster in a similar way to those growth stocks that got crushed. They're the ones that bounced the most this summer, right?
Yeah. So like I said, if the dollar follows that roadmap, whew, man, I can't think of a more bullish catalyst. Can you? Than dollar getting below 103?
I think that is the catalyst. It's not so much the most important catalyst or anything like that. I think that's it. I've been consistent about that. Like, it's not like anything new. Like, I've been pointing to that forever. And now the fact that it's going down and risk assets are doing well, it's like, you see?
Yeah.
But like, I mean, it's not like earth-shattering revelation. I mean, we have the data and the market just continues to prove, right? So you could, the way I saw it, right, like over the last years, you could bet that this is just a coincidence, right? You could make that bet if you wanted to and just be like, oh yeah, just huge coincidence, efficient market monkeys, whatever. Okay.
Wait, what do you mean?
Or,
what do you mean?
What do you mean?
What are you
Like,
talking about?
you could just be one of those people, right? They just say, oh, it's just coincidence, efficient market hypothesis, whatever bullshit, right?
Okay.
Like, I'm not one of those people, but like somebody, there are those people. Or you could be like, okay, acknowledge the correlation has been positive, or excuse me, in this case, negative. It's a negative correlation between risk assets, those stocks and crypto in particular, and the dollar. You could say, okay, but now the correlation is going to change because of the Fed or whatever conspiracy theory you want. You could make that bet too. Or you could make the bet that I was making and continue to make, is that the correlation is going to remain in place and the correlation is going to remain negative, right? And that's the bet that I'm making. And you can make any of those bets that you want, but that's the one that seems the most logical to me. And the market continues to prove that to be correct. So why would I fight that trend? That's the correlation. So if you think stocks and crypto are going to go higher, you need a weaker dollar.
Yeah. So you know what? I want to take a look at energy next. You ready to move on?
I am.
So it's still the best performing sector year to date. It's come in, obviously. We had what looked like a failed breakout in June, and you did see some downside follow through. I mean, energy corrected like 25 at least %. But here we are back to the scene of the crime, right? 79.80. That's been the level for pretty much the decade, right? Or maybe not a full decade, but you know, you get the point. And I don't think we can talk about energy without talking about crude oil, right? So last week, we saw a big breakdown in crude oil below that, I'll call it 94 level. And that was support for the last few months. And it really looked like we were going to head lower. But this week, man, it just looked like we like bull scooped and trapped all the bears down there. Is this a failed breakdown, JC?
That's my bet. And I think we squeeze higher, you know, and then the energy stocks pulled back with oil. Perfectly normal. You know, early cycle, you know, these commodity cycles tend to last a decade. We know that, we have the data. They don't last a year or a quarter or two. It's a decade. And we're in the third year of this bull market in commodities and in energy. So, you know, in secular bull markets, you want to be buying weakness. And that's what we just saw. And I did buy that weakness, right? You know, I like Chevron. It's a nice name. You know, Warren Buffett continues to buy Occidental Petroleum every single day. You know, we've been in that. So I like the energy trade. I like buying this pullback. And if oil's above 93, that's the trade that we want to have on.
You know what I think the biggest tell was? I pointed it out to Steve yesterday. You brought it up today too. The fact that crude oil didn't even reach oversold conditions on that 25% pullback, if you want to call it. I mean, that when you think about it in the context of how strong crude oil has been this year, the fact that we couldn't even reach oversold conditions and now we're back above 94, what does that tell you?
It tells you that you want to be really, really long energy stocks, which I am. So I'm eating my own cooking over here.
I know.
But particularly if you're right, and that's a scoop and score is what we like to call it here at the old All-Star charts.
Yeah, scoop and score for sure. I think, you know, as long as you're above that 94 level, you have to err on the long side for crude and the whole energy trade in general. But you know what, lastly, I want to talk about crypto. You know, you already mentioned some of the levels in Ethereum that you're watching, 1800. If you're above 1800, you want to be long. And you've fallen deep down the crypto NFT rabbit hole in the last year or so. So let me just start off by asking, how are your NFTs doing? I can't have a conversation these days with you without hearing about your crypto punks or your dick butts. So how is the NFT portfolio?
I'm gonna be honest with you. You know, I've been trading Bitcoin. I wasn't necessarily trading it, but I owned Bitcoin since 2014, and we started covering it here at All Star Charts on a professional level in 2016. So I've been active in crypto for a long time, but for all of that period until like maybe 2-3 years ago, it was really just another asset like copper or the S&P 500 or whatever, or right, you know what I'm saying, or Microsoft. It was just like another asset in the arsenal, couple extra charts, no big deal, right? It was to that extent.
I mean, I remember I was there in 2017. You were covering it, but you were saying this thing could go to zero and I don't care, but it's obeying technicals, and that's enough for me to pay attention to.
100%. It trades so cleanly. That's something that always attracted me to it. Also, the fact that we could chart it, and there's like all these Fibonacci extensions, like kissing these levels to a T and reversing. I'm like, yo, this is
it's crazy. Almost like the technician's best friend in my opinion, but it's still early days. Anyway, sorry.
But you know, once I started diving into the on-chain analytics, which I've only been privy to over the last couple of years, I'm sure they existed to some degree this whole time in somebody's basement somewhere, but I never saw it until the last couple of years. And now I just keep getting my hands on more and more data, and I meet the developers of these softwares. So I get all this crazy data because they're not technicians like us, like the things we do, like breadth analysis and equally weighted charts versus cap weighted and like sector rotation, like all this stuff that like we take for granted because we do it every day. These guys don't. So when I explain to them like the things that we're doing with the data, like NFT breadth data and stuff like that, like their heads are exploding. You know what I'm saying? Like on just stuff that for us is just a regular Tuesday. So it's really cool that we can, because we have so much more data in crypto than we do in any other asset class in TradFi, if you want to put it in the proper nomenclature with the kids these days. We have so much more data. So like, you know, things like this commitment of traders report that we have in commodities, like there's that in crypto times like a zillion. You know, the short interest and, you know, margin on the exchanges and stuff like that we get in traditional finance, like that is the on-chain stuff in TradFi. But in, you know, we get everything. Like you could literally look over the shoulder of the Stephen Cohen of crypto trading or of the NFT trading, and it's all anonymous, but you know, because it's all transparent on the blockchain, and you could follow these accounts. You could follow the different sizes of the wallets, the active wallets that have had success when they're buying certain things. There's like, it's almost like, you know, when we look at the, you know, the SEC filings for 13D filings and stuff like that, there's the equivalent of all that stuff in DeFi and NFTs and in crypto. And for me, all of that is fascinating because I analyze price behavior and the behavior of traders and investors all over the world. I've been doing that every day for 20 years. So I'm just doing that in a new asset with new data and figuring out new ways to take advantage of that data. And I'll tell you what, all of that has truly helped my decision-making and my view. And Straz will tell you the same thing. He's actually the one who tells me every day. And I'm like, yes, I know, I told you. You know, it helps us because it's almost like a leading indicator in a lot of cases. It trades 24/7, so you can check things at night. You can
no, it has been a leading indicator this year. I mean, it really has been. And you know what?
Well, that's why.
I'll echo something that I think Jim Bianco said to you in one of your podcasts with him. He said crypto might have been the best thing to happen to technical analysis. And I agree. I mean, what you're saying is basically, you know, we see all this data, and yeah, it might have looked like funny stuff to us at first, but then we're like, oh, we know what to do with this. We have the tools. We know what to do. And
the same
and
thing, they just call it different things. Like, you know, stability pools, you know,
yeah, it really, I mean, it really is like
oh, you mean like a market maker. Got it. We have those.
So I think, you know, the whole crypto space is a really cool sandbox, if you will, you know, to try out what tools we have in traditional markets in technical analysis and try to bring them over to that world to analyze that market. And it's a totally new market. And I think it's a kind of Wild West. I know that's been said a million times, but anyway, so, you know, Ethereum's holding that level. Bitcoin's holding up nicely too, but Ethereum's really been the relative leader. And I know you're a huge relative strength guy. I mean, you call relative strength your cheat code for the market. So I'm wondering if you could just kind of expound on the relative strength in Ethereum versus Bitcoin. I mean, is the flippening upon us or what?
Yeah, I mean, listen, if you're a flippening person, a flippener, is that what they're called? A flippanite?
I don't know. You're up with the lingo more than me.
Yeah, I think is maybe someone who believes in the flippening. I don't know if there's a proper name, but yeah, you know, the relative strength, particularly relative to Bitcoin, has been impressive. Like I said, Ethereum doubled off the lows. Bitcoin's up what, 25%, something like that, maybe a little more, but nowhere near what Ethereum is. And we ask ourselves the question internally quite often, you know, is Ethereum outperforming bullish? Like, is that a risk on sort of thing? And my answer has essentially been, I don't know how risk on that is, but I don't think it's risk off, right? Is sort of where my head is at. I think what's really risk on is the broadening participation we're seeing out of all the other alts. Ethereum is just a good representation of all of that behavior, is really sort of my point, versus Ethereum on itself on an absolute relative basis, if you catch my drift. But it's more so Ethereum's just a representation of the altcoins.
I see. So, you know, what you brought up altcoins. Are there any other altcoins that kind of have your eye right now?
Yeah, I've been in the avalanche, you know, for a lot of reasons. You know, for me, you know, a lot of these altcoins are just growth stocks. You know, they're just software stocks. That's what Howard Lindzen says. He's like, yeah, they're just more software stocks. And that was great.
Right here,
it stuck with me. That's how I looked at it. So when we were buying growth stocks over the last couple of months, you know, avalanche for me was that. I figured that if Bitcoin wasn't going down, it was going to go up. And if Bitcoin was going to go up, then the altcoins were probably going to go up a lot more. So I bought Avalanche as a way to express a bullish thesis in Bitcoin. And sometimes it's better be lucky than good. It worked out like a lot. Like Bitcoin has underperformed a lot more than I thought it would, to be honest. So that ended up working well, favorably for me, better than I thought, really just by dumb luck. But I think that that's information, just how much the alts have outpaced Bitcoin, which is the more safe, you know, lower beta asset of the bunch. I think I would argue that's bullish for the asset class.
Right. I mean, you're demonstrating what I just explained. I mean, you're taking some of these old concepts that we have in TA, like the higher beta outperforming that should be bullish, and you're applying it to this new market. And I think that's awesome. And I think there's, I call it a sandbox for a reason, because I think it's this new playing field where we can take some of our old tools and apply it to this really new, cool concept. Anyways, before you go, I wanted to give you a chance to talk about this new app of yours. It's called Rangefinder. I got a chance to play around with it a couple months ago, and I met the developers. By the way, they're fantastic people. And I got to tell you, I think this app is probably the coolest thing that I've seen come out of All-Star Charts since the beginning of All-Star Charts. So give us the lowdown on Rangefinder. What is it, and how can people find it and check it out?
Yep. Shout out Brett Schaffer, the whole family. You met them. They're great. You know, we do a lot of research here at All-Star Charts, a lot. You know, to the point where sometimes it could be overwhelming, you know, whether it's our breadth analysis, the conference calls that we put on, you know, we have reports that come out every single day, different scans that we run, you know, one is every other Wednesday, one's on Mondays, one's every other Tuesday, right? So we're constantly running these scans, and the frequency depends on what type of scans. There's some scans that we run every day, for example, like the hot corner. So it could be overwhelming at times, like for us, like we do this every day. So like more data, right? But, you know, if you just want to consume it and to be like, well, what am I going to buy? That's where Rangefinder really comes in, because it takes all of our trades and it puts it within range. So you can sort by best risk versus reward. You can sort by individual sector. So let's just say you want the best risk versus reward only in consumer discretionaries. Or, you know, let's just say that you only want American stocks, or you want no American stocks. You just want energy stocks not from America with the best risk reward. Like you could sort by all of those things. You could click on the chart. It takes you to the original trade idea, walking through what the risk is, what the profit potential is. And then it's already baked into the position sizing calculator that tells you exactly how many shares to buy to express your given thesis based on your overall portfolio value, how much you're willing to lose. You enter that, you press the button, it tells you how many shares you should buy based on your personal parameters. Like, it's really, really cool. And it's all built in there, baked in the cake. And we got a lot more features coming. But you're right. When you say it's like the coolest thing that All Star Charts has ever done, based on the feedback that we're getting from all of our customers around the world, they tend to agree with you, Patrick. Which is cool.
I mean, I really think it really is like the missing link to your entire product. I think it kind of brings everything together. Like you said, the one kind of headache about your research, your services, that there's so many good ideas, and this is such a good way to keep track of them, identify them, and stay with them. I love the position size calculator. I think that's a great tool. And anyway, where can people check this out if they're interested?
Yeah, no, I think you nailed it. You can go to allstarcharts.com/app. So it's allstarcharts.com/app. And like you said, we put out a lot of ideas. We always talking about what we want to do, what we're doing, what we're going to do. This app was created to simplify when to do those things.
I love it.
allstarcharts.com/app. And it's
allstarcharts.com/app.
And it's web-based and mobile optimized. So you don't have to download anything. It's super easy. That's the best part, how easy it is.
Well, I actually have the mobile app on my phone. I just kind of downloaded it right there.
Yeah.
But you know what? Anyway, JC, thank you so much for coming on and sharing your thoughts. I'd love to do it again sometime soon.
Yeah, 100%. Listen, if the dollar starts rallying from here, forget everything I said.
All right. Well, have a great weekend.
All right. Adios.
Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thank you.